Dan Geltrude with us, Larry Glazer with us. Gentlemen, good to have both of you. Dan, this is nonstop, and there are every indication right now that it's going to continue for a while. I've already seen that those who were betting on the Federal Reserve maybe starting to cut rates the second half of next year have put it off to well into the following year, 2024. Where are we on this?
Well, here's the problem, Neil. Well, there's a number of problems. First of all, we seem to be fixated on what the Federal Reserve is going to do, as if that's the only thing available to us. It's one of a number of things. Okay, raising the interest rates. We already know, and we've talked about it endlessly. What is that going to mean? Well, if interest rates go up enough and we throw ourselves into, a pretty deep recession as a result, that's not such great news, is it? Of course not. So why don't we really go where the problem is? The problem is on the supply side here. I truly believe if we address energy issues, if we changed policy, we could really take a big bite out of this inflation rise without having all the damage that rising interest rates are going to cause in the rest of the economy.
You know what's interesting, too, guys? Oil is getting back close to the level it was at before Russia invaded Ukraine. I think we're at $92 a barrel at that point. We're now down to 94 as we speak. Of course, it's spilled way over beyond oil and energy and gas and all of that. So that might be returning to pre-Putin levels, if you will, but nothing else is. What do you make of that, Larry?
Let's not beat around the bush. Even though this is July and we're in the heat of summer, this economy is in for some tough sledding, Neil. And I think we're seeing that play out in the weakness we're seeing in commodity prices, the currency challenges we're seeing in the weak euro. We're seeing an inverted yield curve, and we're seeing weaker long-term interest rates, suggesting that inflation is actually not a long-term problem. All send the signal that things are slowing. It's a red alarm that we're heading towards a recession. And today's wholesale inflation data, but also the bank earnings, confirmed what many of us were worried about. But there's a positive to this, is we're getting the bad news that we were worried about behind us. And Jamie Dimon didn't candy coat it, Neil. He told us what we needed to hear, that things are difficult. They're cutting the buyback. They're going to have loan reserves. It is a difficult environment. We need to not candy coat it either and level with people. But Washington needs to do the same thing. They need to explain to people how difficult it is. They need to take the difficult action. And I think the good news here is that this week, we realize Jay Powell is not Paul Volcker, and he has the gravitas of the political will now to raise rates and rip the Band-Aid off that he otherwise wouldn't have the guts to do. And that's what high inflation is going to allow him to do, and hopefully we can get on the other side of this within 6 to 12 months.
But, Dan, I had a flip side on looking at these pathetic bank earnings or the disappointment there, and I'm including J.P. Morgan and Morgan Stanley. They didn't make up for that on their banking investment banking revenues. In other words, how much they make off of trading, because you would think if people are selling, that's an order too. You take it and you run with it. So there's a flip to that maybe not everyone is selling, or they're holding pat here. I'm just wondering what you gleaned from that.
Well, I would think that most investors should be, holding pat here, because obviously to sell low after buying high is not the right formula. So the proper approach here is to hold off and just wait and see, how long this storm is going to wait, or how long we have to wait until this storm passes. Neil, I just want to bring up one other point here related to the other side of the impact of inflation, and that's related to wages, right? For a while, we were saying, oh, well, there's inflation, but these wages are going up. That has stopped now, Neil. Wages are nowhere near rising at the same pace of inflation. There was just a report out today, I believe, that showed that the average annual wages for Americans have gone down $3,400 since Joe Biden has been in office. Is that a real
wage differential factoring in inflation then?
Well, it's $3,400 less in terms of their salary, not talking about the inflation impact. So it's a double whammy.
Did not know that. So, Larry, real quickly on that, what he's saying is, if people, again, in the mass aggregate here, if people were looking at the heady days, 5% wage gains, 6% wage gains, but you have, inflation running, at 10%, 11%, depending where you are.
Yeah.
And we mentioned some of these examples that show, for most folks, that inflation is running at a far faster, higher clip. They're screwed. That's the bottom line, right?
I think the risk is you get into a sentiment spiral where people didn't realize how difficult the economy was because they were getting stimulus money from the government. It was masking some of these issues. But there was a Pew Research study that just came out, and it showed that most Americans now are acknowledging that Washington's policies are making the economy more challenging for them. So I think the message is getting to them. It's going to show up in retail spending if we don't instill confidence and demonstrate some policies to address the situation. And Washington has been unable to do that or unwilling to do that. And I think this is a really pivotal moment where you need leadership to step forward. This is a crisis for families right now, and we need to take action, and it's going to be challenging if we don't do so.
Final word there. I want to thank you guys very, very much. In the meantime,